because even if this rule gets invalidated, if you're a large company, well, California's climate disclosure rule is not invalidated. The European Union's climate disclosure rule is not invalidated, and you're going to have to comply with those too.
Hello and welcome to Off the Books, where we surf the uncharted waters of accounting, finance, risk, and wherever else the waves take us. This episode is brought to you by Workiva, the one platform that brings financial reporting, ESG audit, and risk teams together in a single place, just like your NCAA bracket, but in this case, where everybody wins. Today on Off the Books, we're bringing together the words RAD and compliance, and more on that in just a second. But first, I'm Steve Soder, accounting enthusiast and Diet Coke aficionado, looking forward to debating a great conversation, and I'm so happy to have you with us. Also very happy to have Catherine Tsai joining us. Catherine, could you introduce yourself for our audience?
Yeah, I'm not an accountant or a Diet Coke aficionado, but I like asking questions and learning from smart people. And I'm really excited to hear from Matt Kelly. Matt, you've been on the show before, but could you remind everybody who you are?
Sure. Thanks. And I'm delighted to be back again. Hello, everybody who's listening here. So my name is Matt Kelly, and I publish a newsletter called Radical Compliance. And I am essentially an independent journalist and analyst of the governance, audit, and risk management scene. And I publish the newsletter every Friday and run it as a blog throughout most of the week. And I've been doing this for 20 years now, since right after Sarbanes-Oxley was originally passed. And I love talking about these things. I think the challenges that internal audit and compliance professionals have are endlessly fascinating. So we can talk all day long. As far as I'm concerned, let's do it.
Well, we do want to get to it. And one of the things, Matt, that we were really interested in getting your perspective on was an audit and compliance insight on the SEC's recently adopted climate rule, as well as a recent proposal by the PCAOB to require a company's external financial statement auditors to consider any non-compliance with laws and regulations that might be going on at that company as part of their audits. I realize it sounded a little bit technical, but that could have major implications. And boy, it just seemed like you would be a terrific person to lend insights in these two areas.
On a previous crossover episode with our sister podcast, ESG Talk, Steve gave a summary of the SEC climate disclosure rule. And Matt, we're curious from an internal audit perspective or a governance risk compliance perspective, what are some of the highlights of the rule for you?
Well, I think the thing that jumps out to me is, first, how much of the rule is not there compared to what was originally proposed 2 years ago, when they were going to include the so-called Scope 3 emissions you would have to assess. That's the emissions caused by your supply chain. That's gone. For smaller companies, you don't even have to disclose any greenhouse gas emissions in Scope 1 or Scope 2. But for larger publicly traded companies, accelerated and large accelerated filers, you do. And we could get into the challenges around that. But I actually think that from an auditor's perspective or a more broad risk management perspective generally, all companies starting next year are going to have to disclose their material climate risks and what is the process your company has for identifying and assessing and managing material risks related to climate? And one more, whether any of those processes for climate risk are integrated into your overall risk management system or process. So it's really much more about how you, the company, think about what a material climate risk is, how you figure out that it's material, and are you managing this risk in a siloed sort of a way or in a more integrated way? And in fact, Catherine, what really jumped out at me is I was thinking about that specific list of disclosures. The language for this is almost identical to the language the SEC adopted last year for material cybersecurity disclosures. You have to disclose material cybersecurity risks and what is the process for it, and is that integrated into your overall enterprise risk management system? So it's really much more about, do we, the company, have, I call it the grand unified theory of risk management, that you have some sort of disciplined way to assess what a material risk would be and how material is it, regardless of the actual risk. That's just insert risk here, whether that is climate, whether it's cyber, whether it's supply chain risk or something else. And that's the sort of thing that I think companies will really have to think about, because all companies are going to have to grapple with this. There is no exemption from it, and you're going to have to grapple with it now because you have to disclose it in your annual reports next year. So you have 12 months to get this figured out. And so I think that is the here and now for most audit and risk professionals.
I'm so glad you brought up the connection between climate and cyber, because when I first read the language, that was sort of brewing in my head. And it was only after, I'd say maybe even a week before I really started to connect the dots. And I think, Matt, what's so interesting to me is that cyber, you would have isolated incidences that you may have disclosed or may not have disclosed. Obviously, there's a new cybersecurity disclosure rule out there. Maybe something hasn't happened since then. But I suspect companies have been talking about climate risks in one form or another, somehow, somewhere, either in a standalone sustainability report. Maybe it's made their way into their SEC filings. And so to me, I think that the rigor now becomes, okay, we actually have said these things publicly before about potential risks. Boy, does that really stack up with now we have to think about these risks for purposes of the 10K. And are we using a similar framework across climate risks and cybersecurity and actually other areas that I think it could end up being sucked into potential risk disclosures? This all kind of came together and crystallized to me to think, you know what? This is a really tricky challenge, because it's not just about climate as much as it is about the overall risk process and identification process that companies are going to have to think about now, I think with a lot more rigor than they were, let's say, well, even a year ago, right? Even before cyber, for example.
Yeah, well, I think that is spot on. Cyber is almost easier to think about because we all kind of sort of know what a cyber attack would look like. And, if what is a material cyber risk? I always say it is that attack which makes the CFO say, how the F did this happen, for lack of a better word. But, when the CFO or the C-suite drops an F-bomb when they're told the news, that is a material cyber risk. I don't know what we can actually say for a material climate risk. It's not that tangible. But nonetheless, I think that, you're going to have to think through, why would we govern one rather than differently from the other? So, for example, you would have to disclose in cyber, does the board have a committee that thinks about cyber risk? I would guess most large companies at this point, they do. I don't know that you can say the same about climate. And then comes the question, well, why not? And you're going to have to give an answer to that question. Or another way of looking at this issue, Steve, since you mentioned some companies have been disclosing climate risks in a sustainability report, yes, they have. And already the Securities and Exchange Commission has started making comments in the 10K or the 10Q in those filings. They will send a comment letter back to the company saying, well, in your sustainability report, even though it is not technically, it's not filed, it's not legal liability attached to it, but you said this thing over here in the sustainability report that you're going to get to net zero within 3 years. You don't talk about net anything or any 3-year plan for transition in your 10K or your 10Q. Why not? That's already been happening. And the SEC, to the best of my recollection, has not actually issued an enforcement action along those lines yet. But now that, essentially the sustainability reports discussion and the 10K reports really should be either identical or absolutely support each other, I think we are eventually going to see some sort of enforcement risk from, you're saying one thing to look good to the audience, but you're not saying the same thing in the 10K for serious investors. Why not? And it's really, I think, going to drive the conversation hopefully upward, because the board probably will need to think about, why aren't we having a climate discussion? Or if we are, is it being handled in the right way? Does it need its own committee? Can it be the full board? What are we doing? All the points about frameworks, are they consistent or not? That's all going to become much more important to think about and get right.
A fancy accounting and finance honcho like you shouldn't be wasting time chasing data or copying and pasting numbers. No, use your fancy degree the way your parents always hoped you would. Workiva can help. Whether you're prepping or auditing annual reports or quarterly board presentations, you can use the Workiva platform to automate risky manual processes. Accelerate how you collect, report, and audit financial and non-financial data without sacrificing accuracy so you can stand behind your story every time. Learn more at workiva.com/accounting. Well, what about the lawsuits that are challenging the SEC climate disclosure rule? Does that affect how companies should be getting ready?
Well, no. As the practical point here is that these lawsuits came fast and furious, and just to appreciate the legal weirdness of this, within 3 days of the SEC publishing its rule, the oil and gas and commercial interests were suing that it went too far, and the environmental interests were suing the SEC that the rule did not go far enough. They were suing in different districts. Different people were suing different issues. So eventually they settled all of this by lottery. There were, I think, 6 different lawsuits in different parts of the country that ultimately went to one specific court, which is the 8th Circuit. And don't ask me where in the country that is, because I forget. I have no idea how these court rulings might proceed. But I think for large companies, really, it is a perfectly legitimate question to ask, who cares? Because even if this rule gets invalidated, if you're a large company, well, California's climate disclosure rule is not invalidated. The European Union's climate disclosure rule is not invalidated, and you're going to have to comply with those too. So it's more like the time has come, especially for large companies, that you have to figure out what are our emissions and how do we assure them that they're accurate, and then we have to disclose them somehow. And that's that. I mean, I have no idea what's going to happen with this litigation, but really for all of the larger companies, doesn't make a difference to you. You're still going to have to do this.
Do you think, Matt, from a investor communication standpoint, I mean, to anchor on what you just shared, if you're a big company, it doesn't really matter. Then do you think from an investor communication standpoint, this is an opportunity to maybe go beyond just a check the box compliant exercise and say, hey, I'm going to have a meaningful dialogue, or I want to have a meaningful dialogue with my investors and shareholders. So I'm going to have to do this anyway. I might as well make it count for something, because investors and others actually care about what my impact is. They care about the risks that may represent to me as either a company you want to do business with or me as a company you want to invest in. I'm curious if that changes the consideration from an audit and risk standpoint when it goes beyond just a check the box compliance exercise to a meaningful dialogue that you're having with investors or other stakeholders that might be interested in this information.
Well, I think that it is a good thing to do to have a substantive conversation about this. If the company's actually serious about doing that, then yes, you could say it. And I think there are a lot of ESG conscious investment funds out there that would be happy to have that conversation. I do think that any companies that are going to just say that they take it seriously, but then they don't, that's like, don't do that. Just, if you're not going to take it seriously, shut up and don't take it seriously. But I think that no longer can a company pay any sort of lip service to being environmentally conscious and thinking about greenhouse gas emissions. Either you're thinking about it thoughtfully or stay quiet and don't, but don't mislead investors. For the internal audit function in particular, though, let's say the company is serious about improving its environmental risk awareness and then having good conversations with investors about it. The audit team would have to think through, do we have the right resources and people to be able to do that? Going back to what I said at the very beginning of this podcast about whether you have processes to assess climate risks and are they integrated with your enterprise risk management system or not? It's really about, is this siloed or not? Well, if it's siloed, think through what that would mean. It probably means some sort of EHS function at your company, environmental health and safety. Maybe they've been kind of, sort of taking point on greenhouse gas emissions as best they could, but I don't know how many EHS functions can really do that, because mostly that's about environmental laws and anti-pollution protections, which is not the same as measuring greenhouse gas emissions and trying to reduce them. So, does the company have really the capability to assess its environmental issues and its climate-related risks in a good, substantive way? That is a question of good systems, good processes, good people. And that's the sort of stuff that a chief audit executive would need to be thinking about right now. If the company is serious and it wants to make a good impression and a good dent on addressing climate-related risks, do we have the right people on staff to do that? And do I, the head auditor, have the right people in tech and staff to be able to assess whether we do?
I would add to that it's not just about incorporating all of those risks operationally or the assessment of those risks, but it's also about the materiality. If you've identified risks that are significantly material, that then triggers potential disclosure requirements and other things. And that's not just a simple, hey, is this a dollar amount and is it a percentage of revenue or a percentage of net income? Now we're talking about non-financial concepts of materiality that need to be incorporated into all of that. It's not just about the risks, but there has to be that disclosure threshold of what do I say and where do I say it? And is that consistent across? Because if I said this thing was a really big deal in a sustainability report, but I made no mention of it whatsoever in an SEC filing, I think the commission is going to challenge that.
I would think that you're right. And for example, one big question would be your net zero transition plan. What is going to be a material risk to be able to do that? Oh, I don't know how many companies have sat around and actually thought about it. We've been saying that we'll do it for 3 years, and we've been saying that for the last 10 years. And that's not going to look good. You would have to actually change that and put in the resources to be able to make the transition in 3 years, or turn around and say, we can't, we're going to do it in 5 or 10 years. But who would be involved in figuring out what that plan would look like? Those are the kind of challenges that are coming very soon.
I wish we could keep talking, and we do still want to talk to you about NOCLAR, so I think we need to bring Matt back for another episode. What do you think, Steve?
You know what? I would love it. Any opportunity to talk to Matt is a great one to take, in my opinion.
Always.
So, Matt, as we get ready to wrap up here, quick closing question. We know that auditors aren't often seen as superheroes because if they do their jobs right, then nothing bad happens. But if you could create an internal audit comic book superhero, what would their name be and what would they be doing?
Okay, so I gave that some thought and I had no good ideas myself. So I asked ChatGPT, and its first answer was Audit Man. And I thought to myself, that stinks. Microsoft has dropped billions of dollars into this product and they gave me Audit Man. And I asked ChatGPT, do better, give me a better name. It came back with Forensic Falcon, and I think that is an excellent name. So now I'm back on board with ChatGPT running the world, because that is a better name than I would have come up with.
I'll tell you what's funny is that you and I are very connected in our way of thinking, because I also asked ChatGPT and I got Guardian of Financial Integrity, the Sentinel of Compliance, or the Vigilant Auditor. I actually like yours a lot better than these, but that's funny. We both would have gotten a ChatGPT to answer the question. Catherine, what did ChatGPT tell you?
I should have used ChatGPT. All I could come up with was the checkmate. Clearly, I need to use ChatGPT more often.
Oh boy. Well, Matt, we will bring you back for a part 2 of this discussion. In the meantime, thank you so much for joining us. This has been Off the Books, presented by Workiva. Please subscribe, leave a review, tell your buddies if you like the show. And if you're watching this on YouTube, we would love to hear what you think about this by adding a note in the comments. Surf's up, and we'll see you on the next week.